I'm going to cheat a little bit. I'm going to pick two funds, but I'll explain why. The first one is called Wynd International Investment Trust. Now, this fund invests globally, so it can invest wherever it sees fit, and it predominantly invests in high-quality businesses. But the reason why I'm selecting it for 2020 is because it has a strict valuation philosophy as well. So when a share that it owns becomes too expensive in the manager's view, they will then sell the share. I think 10 years on, well, over 10 years now, since the financial crisis, I think valuation is incredibly important in a world where growth stocks in particular do look very pricey because they've had a really good run. And another reason why I like the trust and have selected it is because it only has 9% in the UK. UK investors generally have quite a high amount of home bias, and a lot of investors will not actually realise how much of a home bias they've actually got. So I think if you're going to pick a global portfolio, it's important to ensure that it doesn't have too much in the UK. Now, my second choice is a UK portfolio. The trust I'm picking is called Temple Bar Investment Trust, and it's managed by Alistair Mundy. Now, this trust has a value focus. So the reason why I've selected it alongside Wynd International is because they're two completely different portfolios, and I think that they'll complement each other depending on what 2020 brings. Value over the past 10 years has underperformed growth markedly, and I think 2020 could be the year where that starts to reverse, but I wouldn't want to stick my neck on the line and say that that will definitely happen and put all my eggs in one basket, so to speak, which is why I think that Temple Bar and Wynd International do complement each other because they are two polar opposites.
The UK has basically been very unloved for a long time, and the election has brought some certainty. And I think that this fund is going to be a very good way to play the likely recovery of the UK market over the coming year and beyond, maybe. It is invested in mid-cap companies, medium-sized companies. It's very well diversified. There's about 100 holdings. Over the last year, the share price is up more than 50%. Over the last 5 years, it's up more than 110%. And the manager, Guy Anderson of JP Morgan, he's not constrained by being either a value investor or a growth investor. He just looks for good, strong companies. Now, there's an argument that buying it now is coming a bit late to the party. But for me, I don't think that that's important. I think it's a clear case of time in the market rather than timing the market, because although the discount has narrowed, it was about 14% in August, it's now narrowed to under 2%. So all that extra share price gain as the share price closed on the net asset value I've missed that. But nonetheless, I think it's still a very good fund for a long-term holding. It's a very cheap fund. It's huge. It's by far the biggest in the UK all companies sector, but that size has enabled it to reduce its annual charges a couple of times over the last 3 years, and it now costs about 0.45%. It pays a dividend. It's not a huge dividend, but it's about 2.6%. That's a nice little addition for an investment trust that doesn't actually set out to be an income-paying trust.
So the trust invests in undervalued small-cap Japanese companies, but what makes the trust unique is its attempt to try and find companies with large amounts of cash on their balance sheets. This is not too hard to do in Japan because over the deflationary years, many Japanese companies built up large amounts of cash on their balance sheets. But with corporate governance norms becoming more friendly to shareholders, the trust hopes to encourage these companies to put this cash to better use. That could mean investing for potential future growth or returning capital to shareholders. This is not a new approach. It has a long history, going all the way back to Benjamin Graham and his battles with the company Northern Pipeline in 1927.
Well, first of all, it's an exchange-traded product, and palladium, as hopefully people know, is a metal, and it's a metal that's in very high demand. And it's in demand because it is used in auto-catalysts, or what you might more commonly know in the UK as catalytic converters, which are used to reduce emissions in carbon-based vehicles, in other words, cars. And regulations are in place, and more are coming down the line, to reduce emissions. So, the demand for palladium continues to rise, which explains why it's been in a bull market since 2016. And there's an old adage in investing, which is don't fight the trend. And this trend is going upwards.